Good morning, good evening, good afternoon, everybody. I am Kamari Ellis. Welcome to the Finance Rebel Show. I'm here kind of on a day that I'm usually not. It's a Friday night. But listen, since everybody's quarantining and I'm quarantining, I figured I'd come on and talk about a couple of things. Come on and talk about some money, talk about some stocks, and talk about some of the bad advice that's floating around out there. Talk about some of the misinformation that's floating around out there. And sadly, a lot of times, if you saw my video earlier, right, I asked the question that why do so many people flock to the people who are the least qualified or give out the worst information? And so, there's a lot of people out there that just give bad information. And listen, I'm not perfect. I'm no black Messiah. I'm no black Jesus. But I do a fair amount of studying, and I've committed my life to this. And there's just some things that, you see and just make you scratch your head. Now, I'm not messy. I'm not coming for anybody. But however, I consider myself a steward. So I always want to put out good information to at least counterbalance the bad information that's out there. So if you know anyone that's looking to increase their financial IQ, share this with them, invite them on over, and we can have a good time talking about money, figuring out ways we can increase our financial IQ. So today I want to be talking about dividend stock value traps. Dividend stock value traps. And what exactly is a dividend stock value trap? A dividend stock, it's also called a yield trap as well. So a yield trap is called, what a yield trap is, right? You'll see a stock out there floating around in the market. It's got an awesome dividend. People think it's great, and they will begin to invest in it because they're, right now, everybody is looking for yield or looking for income. We have a lot of retirees out there or soon to be retirees out there, and they're looking for other ways to generate income. They're looking, and even people outside of income, they're looking for other ways to increase their overall rate of return. They don't like what they see in the banks. They don't like the interest rates that, CDs are giving. And so they say, well, I can make more money by investing into some of these high yielding stocks that are out there floating around. However, they don't understand the risk component when it comes to investing. And I find that a lot of people don't understand the risk component when it comes to the stock market, because every investment has a different level of risk associated with it, right? There's no such thing as a free lunch. There is no reward without risk. Now, sadly, right, when I say there's no reward without risk, there are some things that are good financial tools that don't have the greatest level of reward. However, they don't have the greatest level of reward, but they also don't have the greatest level of risk either. So I'm looking for something I want to show everybody something real quick, because I want to talk about different asset classes and how we should begin to think about them. So give me 1 second. I want to share something on my screen for my people that are on IG. Just bear with me. Maybe I've been thinking about showing my screen that I broadcast through Facebook and YouTube to my IG people. I'm not sure if that would be a great experience though. So I've been kind of holding off from it. So give me 1 second. And I had this before. I actually made one of these myself. I'm looking for now I'm looking for an asset allocation pyramid. And so in this pyramid, it has different layers, or different layers that'll make up a pyramid of what your base investments are, your most risky investments and your most risk-less investments. All right, so just give me 2 seconds. 2 seconds. Ooh. I didn't know this was going to be this hard. I actually had one of these. I actually made one, but I can't put my hands on it real quick. So as we're talking, I just want to tell everybody, oh, Prez J2 has joined us. Welcome, welcome, welcome. My man Jimmy's here. Jimmy just got off his live. Shout out to Jimmy from By the Hood. All right, perfect, perfect. Jimmy and Corey just got off. They just did their live on YouTube. Carol Allen, how are you? Welcome, welcome, welcome. Coming through YouTube. And let's see. So I'm going to share the screen real quick. I'm going to share the screen real quick. And the Techverse is not cooperating with me that much today, folks. I don't know why, but it is what it is. Let's see. That ain't gonna work. All right. Well, anyway, I just want to I'll talk about this. I don't want to hold you up all night because that ain't fair to you. It's definitely not fair to me. But here's the thing, right? So when you think about a pyramid, at the bottom of the pyramid is the base of the pyramid. It's the foundation of the pyramid. Just like when you're building a home, right? It makes no sense to build walls, framing, sheetrock, plumbing, electricity without having a good foundation. Because without having a good foundation, none of that other stuff matters. Why? Because it's all going to fall apart at some point. At some point, it's all going to have a bad effect. You're going to see a shift or a settlement shift, and it's not going to work. It's not going to work. And so you'll have falls falling out. You'll have you'll have your plumbing getting messed up because you need your plumbing to be on a certain pitch. Like it's really crazy. It's really crazy. So I'm going to share a screen. I don't know if I'm going to get the best resolution. I need to actually go back and find this. But what I'm looking at on the screen right now is what's called an investment pyramid or a financial pyramid. And so can everybody on Facebook and YouTube see this okay? So again, when you look at the bottom, you have a base, right? You have your treasury securities. You have U.S. insured checking savings accounts. You have life insurance cash value. You have U.S. insured certificates of deposit. And you have EE and HH bonds, right? Those are the bonds that Nana used to give out when new babies were born or when somebody graduated from high school and they wanted to give them a gift. Now you even have I bonds. So that is the base level of the pyramid, right? These are the things that have the most amount of security, the least amount of risk, but they also have the least level of reward. And so each level of the pyramid has a lower level of risk and a higher level of reward, right? So when you think about the whole risk reward scenario, the more risk you take on, supposedly the more reward you take on. Now, at some point, it doesn't make sense to take on more risk or try to get more reward because you have to take on more risk, and it just becomes unrealistic to try to get at some of these things. It becomes almost impossible, right? And I call like, for example, let's think about lottery tickets. Now, Jimmy is my partner on the Blackwell Project. And so I talk about lottery tickets all the time. He talks about lottery tickets all the time. And so what we're saying people are chasing lottery tickets, they are chasing something that's really hot, really sexy. You don't got to put a lot of work into it. You don't got to put a lot of money into it. However, the lottery ticket pays an exorbitant amount of money, right? It's not always Powerball money, but sometimes that Powerball, that Mega Millions money, that's set for life money. But what are the odds? The odds are like 1 in 100 million. It's like 1 in some quadrillion number that's like so crazy that 9 times out of 10, you're never going to hit it. It's really hard to get to that. You can apply that same logic, that same thinking to investments, right? So typically, you're not going to be able to put $1 or $2 to make $1 million bucks, right? The risk of that is really high because the probability of that is almost impossible. So basically, when you go to the lottery store, your 7-Elevens, your Wawas, your gas stations, you basically giving your $2 or $3 away with no opportunity of ever getting it back. And so that's a good example of risk reward. Even though it's a little bit of money, your chances of potentially getting are practically zero. It's practically zero. And so again, when you think about investments, you want to kind of think about it in the same way. So again, going back to the pyramid, at the bottom of the pyramid, you have your treasuries, you have your government issued bonds, you have life insurance. All these things are secured, but they usually don't pay a great rate of return. They usually don't have high interest rates. All right. Then at the next level, we have what's called high grade municipal bonds, high grade corporate bonds, and you have money market accounts. They tend to pay a higher rate of return. They tend to have higher interest rates. They tend to make investors more money over time. Next level above that, going up the investment pyramid. Again, I hope everybody can see this. You have balanced mutual funds. Now, if you've been watching me for a while, y'all know I am not a fan of mutual funds. But we'll say mutual funds, ETFs, and things like that. So that's the next level. And then you also have high grade convertible securities, high grade preferred stocks. So you at the third level, right? Again, balance. And when they say balanced mutual funds, they're doing like a blend of stocks and bonds. When they say high grade convertibles, those are bonds. Those are bonds from a corporation. When you say high grade preferred stocks, right? Preferred stocks typically pay a great dividend. They usually don't fluctuate as much as common stocks or regular stocks that you see every day on the stock market, but they fluctuate. So there is some risk. All right. And so then when you look at high grade common stocks and growth mutual funds, they're more concentrated into stocks. They're more concentrated into stocks that fluctuate a lot. And so it becomes a bit more risky. All right. And then the next level up, they talk about limited partnerships. Then they talk about real estate investment properties. Then they talk about puts and calls. Puts and calls are options contracts. I like ETFs, Jimmy. So ETFs are index funds. And so then the next level going up, right, is speculative common stocks and bonds, gold and collectibles. Now, when they say speculative, right, there's no real hope for those stocks to potentially make any money or make any profits. Penny stocks, I think, would be a good substitution for speculative common stocks. There's some other stocks as well, right? And then futures contracts. So I'm just giving you this layout because I kind of want to give you a rubric on how to think about risk reward and what kind of investments you should be thinking about, right? So as it says on this chart, it says increasing risk of loss of principal increases as you go up the pyramid. All right, increasing potential for capital appreciation also goes up as you go up the pyramid. Increasing risk of loss or purchasing power goes down when you go down the pyramid, and increasing safety of principal goes down as you go down the principal, right? So a lot of people have been talking about inflation. They've been talking about inflation since the Great Recession during 07, 08, 09. Now, I'm not going to go into it too deep, but I will say this, right? If you leave all your money in a savings account, typically your money's not going to outperform inflation. Typically, we are living in a different time period now. Before, everybody was worried about inflation spiking as you pump money into the system. We're still having the same issue now where the government is pumping more money into the system. However, we have more places to buy stuff from. So we have more purchasing power than we ever had before. So we're not really seeing inflation as much. But again, going back to bank accounts, you're not really going to get a whole lot of money out of them, right? In terms of interest rate, in terms of rate of return, because they are relatively safe, right? They're not going anywhere. Usually, even if the bank goes out of business, the government is going to backstop your deposits. So it's a very, very safe place to put your money, especially when we're talking about savings. Now, a lot of people like to try to juice up their savings. So they look for alternatives to invest into. And so when they look into those alternatives, many times they don't understand that they're taking on more risk and moving up the risk chart, right? And so, like I said, many times, going back to the original premise of the show, many times people research and search for higher yielding dividend stocks that pay high bonds. Sadly, they are not safe, right? So a lot of times people want to use dividend stocks to juice up their savings, but in actuality, you're actually playing a different game when you put your savings into the stock market. Some people can do it. You should really be ready and able to understand the risk that's going along with it. And it shouldn't be your rainy day fund. It shouldn't be your if the roof falls in fund money. That should be money that you have over and above your overall savings goal that you're putting to work in more diversified type things. So listen, shout out to Kevin Matthews. That's my guy, Kevin Building Bread. So I guess he knows what I'm talking about, right? How you doing, Denise? Welcome, 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 welcome. But again, I really think it's important for us to understand the role of investments, understand how they interplay with one another, understand why you should be using savings for one thing, stocks for one thing, bonds for another thing, or potentially in combination. We want to keep your money safe. So that's why I talk about all this stuff. And so again, people are looking for yield. The banks aren't paying any money. So people are now in search of higher yields, i.e. dividend stocks. Sometimes we talk about REITs. Sometimes we'll talk about utilities, right? Because utilities typically pay a higher dividend than most. And so you have to be very, very careful. Corey Camp, my other By the Hood brothers here. How are you? How are you? Now, y'all just got off live. Corey and Jimmy from By the Hood do a live every Friday as well. So, you know, one of their slogans, and I don't know if I've ever heard them say this before, but it definitely resonated when I was talking to them, is community first. And that's probably why I work with them, because they're my partners with the Black Wealth Project, because I am also a community first kind of guy. I fervently believe in community first. That's why I do this. So again, back to dividend value traps, right? So y'all got the pyramid. You understand that every investment is not the same. You understand that every investment has a different risk profile. You understand that the more riskier an investment, the more likelihood you're going to lose your money. All right. So I want to talk about dividend value traps real quick. And so just going to Jimmy, I see your comment, but it's kind of long, so I'll come to it in a minute. So just coming to, I'm going to dividend.com, right? There are several resources out here. All you got to do is Google. However, just like anything else, there are some that are good and there are some that are trash. And you have to be the filter to go through and sift, sort, filter, and screen through the garbage and the minutia to find the gems, right? Just like social media, right? There's a lot of good people out there. There's a lot of trash people out there. I'm just keeping it 100 with y'all. Sadly, again, I'm still baffled by why all the trash people get so much of the attention. And listen, I'm not hating. I'm really not. I'm talking about this from a stewardship standpoint. I'm talking about this from when I see, again, my man Kevin Matthews. Me and Kevin have never met, but he puts out great stuff all the time. Again, I work with Jimmy and Corey. They put out great stuff all the time. They're not just putting stuff out that's going to hurt people. They're putting stuff out that's backed by rationale, common sense, and understanding of the market as well. So, like, you need all of that. You need all of that. So, listen, y'all need to be avoiding all these people that's telling you to get family LLCs. Y'all need to avoid all these people that's telling you to hire your kids to go into business so you can only get the tax write-off, right? Again, I told y'all the other day during my live, there are no bad financial tools. There's just bad financial strategy. And so when you separate the tools from the strategy and you talk about them separately, typically it's a recipe for disaster. All right, so just keep that in mind. So, all right, let's talk about dividend value traps. I feel like I've given enough context. So this article talks about a dividend. What is a dividend? A dividend is a payment from a publicly traded company. All right, for this conversation, you could also get dividends from non-traded companies, but for this conversation, we're talking about dividend stocks that trade on the stock market. All right, so they come from typically established companies. Sometimes they're new, sometimes they're old. But I wanted to show you this definition right here, the value trap. Some deals are too good to be true. Consider a used car dealer offering you a large discount on a car you're interested in. If the discount is too big, you begin to question the motives of the salesperson and start wondering whether you're being offered a lemon. While at any given time, there are potentially hundreds of stocks poised to provide a great return to investors, a very high dividend yield warrants further investigation. I'm going to read that again. A very high dividend yield warrants further investigation. The dividend yield is determined by taking the yearly dividend payment and dividing it by the stock price. All right, so for example, if the dividend pays, if a company pays a $10 dividend yearly, the stock price is $100, you divide that $10 into 100 and you have a 10% yield. All right. Same thing. If the stock is $50 and the dividend that's paid out every year is $5 for the whole year, your dividend yield, again, will be 10%. All right. So the first sign of a value trap can be when you see a company paying a much higher dividend yield than its peers. When you see something like this, don't just accept it. All right. So listen to that, right? So I don't want to just read to y'all just for the sake of reading to y'all. I want to give you some context around this. It said it's peers, right? So one of the things you should be doing when you're investing is comparing a company to its peers, because typically its peers are in the same industry. They have the same problems. They're paying some of the same wages. Even some of the prices they may charge to the marketplace may be the same. So it's a good way to see, is this a good company? Is this company in line with everyone else? Or is this company just out of whack? And it could be out of whack, right? For various reasons. But typically it's out of whack because it's not being run well, 9 times out of 10, or it's in trouble. So when you see something like this, don't just accept it at face value. Take a closer look. Question whether the company has the ability to meet its obligations. Basically, does it have the money to pay the dividend? All right. Think about it. Just like you, every month you get your money in from working your job or your business, and then you got to pay your bills, right? You can't just keep all the money. And if your bills are higher than the money that you put in, you usually run into trouble. Not unless like you got a rich uncle or a rich daddy or some long far away auntie that helps you out from time to time. But I know for my audience, most of us, we ain't rocking like that. So, you have to be good stewards of your money, right? And you see here, it talks about it talks about what happens when the dividend payment is unstable. Now, there's a bunch of companies this year with COVID-19, with the market crash earlier this year, that suspended its dividend. Now, y'all know I've been buying Ford, right? Ford had a very, very sexy dividend. I didn't buy Ford for its dividend, but Ford's dividends got suspended. It got cut. It got out of here. Why? Because they want to conserve their cash, right? So just like if you lost your job and you're looking at your bills and you say, oh, I need to cut my spending. Lots of times board of directors look at it the same way when it comes to the dividend. So the board ultimately of a stock company is going to say, we're going to approve this dividend to pay, or we're not. We're going to cut it. By the way, boards also can increase the dividend or lower the dividend as well. Once you pay a certain dividend level, doesn't mean it's going to change. So y'all remember that. Once you pay a certain dividend level, doesn't mean it's going to stay the same. It can change. It can change very quickly, very frequently. All right. So when you think about this, right, I just kind of gave y'all the scenario of how you come up with the dividend yield. And you know the dividend and the stock price, they're tied. And so if your stock price falls, your dividend yield typically goes up. And usually what happens when your stock price falls, something material, like when I say fall, I'm talking about something very material, something drastic, right? 5, 10, 15%. We saw all that this year. So when we see them fall, when we see the stock prices fall, the dividend value will rise. But the dividend value didn't rise because the company was more profitable. The dividend rose because the stock price tanked. And a lot of times, and I'm not going to get too technical with y'all, but a lot of times when the stock price falls, is because the company is potentially transitioning to a worse position, or what I might call a trash position, right, from a better position. And that's not always the same thing. And so, when you think about that, when you think about, yes, Tesla had a great week, but Tesla doesn't pay any dividends right now. So that's a little off kilter for what we're talking about right now, Jack. But yeah, that could be an instance just like that when Tesla had a rough week this week. So sometimes you'll see a stock price get shocked and it fall for various reasons. And then sometimes you'll see that it becomes an overall trend. And so when it becomes a trend, you got to beware. And so you're looking at all kinds of situations, and it's like, wow, this stock is really sexy. This stock looks really good. I can make some money off this stock and not do anything. And so what I see is a lot of people want a free lunch. And what it means by free lunch is they just want to show up, they want to get their plate, they want to get their food, and they want to eat. And listen, the only place there is free lunch that I know of is prison. And actually, that usually ain't free either. There's usually some kind of restitutional fee that you have to pay as well. So always be careful about getting a free lunch. It usually comes with a cost of some sort. But back to dividend value stocks, right? So I've been explaining to you the relationship between risk and reward, looking at different asset classes and their overall characteristics, how some assets are safer than others, how some assets pay higher gains than others, but they typically have a higher risk profile with them, right? And then we're talking about how other dividend stock companies sometimes pay a higher rate of return. So there was one company that I really loved. Let me see if I can pull it real quick. It was Starwood. Starwood paid a great dividend. Starwood is, I want to say, one of the biggest REIT companies, one of the biggest mortgage REITs in the world. And so Starwood right now, Yahoo is really changing. So if y'all been rocking with me for a minute, y'all know typically when I show y'all stock, we typically go to finance.yahoo.com. But now they're doing all kinds of pop-up ads. So that's very interesting. Very, very interesting. So I want to go over Starwood with y'all right now. Now, Starwood's a REIT. They're a mortgage REIT. Biggest mortgage REIT in the world. All right. Right now, the stock is trading at $14.47. They have a lot of hotels in their overall portfolio. They pay a 13.01% dividend. Now, y'all tell me, does that sound good? Does that sound great? Does that sound sexy? Year to date, started the year off at $24.77, and right now it's at $14.47. So part of the reason why the dividend yield increased was because of the rate fall. Now, one of the things I always like to do when I look at a stock is I want to see where the money's coming from. So this year they had a little under, well, let me say this. Let me go there. The last quarter, they had roughly $154 million in revenue. And they roughly had 66 million in losses. That ain't sexy. That is not sexy at all. So if they're bringing money in, but they're losing money, largely because of COVID, right? Largely because travel's down. Largely because a lot of the companies and the mortgages in their portfolio are not performing right now. They got some issues. Hey, Kelly, how you doing? So right now, I'm looking at their total assets, and they are not giving me what I want. So what I want to do is I wanted to see how much cash they have, and it's not showing me how much cash they have on hand. So when you're looking at something like that, remember I talked about the stability of the dividend. How stable is that dividend payment, right? You see this sexy dividend payment, this 13% dividend payment, but the company's losing money. So how long can they afford to pay for it? Now, I would talk to you a little bit more about dividend payments and dividend financing, but I don't want to get too lost in the sauce right now. I will say this, though. Always beware of a company that is paying dividend from debt versus the cash flow that they're making. Typically, that's not sustainable. So Starwood won't come up on finance.yahoo.com. So let's see if I can find their last quarterly report. Give me 2 seconds. 2 seconds. And usually you can find that by going to the website. And so what I'm going to do here is I want to share this on the screen real quick. Real quick. Okay, so as of today, Starwood has approximately $800 million in cash. That was on March 27th, 2020. So they had $800 million in cash. I can't see how much debt service they need. Basically, how much do they have to pay to pay off their debt? They did pay their dividend, right? Which is 48 cents. They do have access to credit and credit lines and things like that. But just right now, at first glance, they have $800 million in cash. But they're losing about 60 million in the last quarter. And so if you just extrapolate that out for the next couple of quarters, do you think they'll be able to maintain that dividend? Right? And so people might jump into a Starwood and they might say, oh, this is sexy. It pays a 13% dividend. However, the dividend is not sustainable. Again, they have a 13% dividend. As it stands right now, more than likely that dividend is not sustainable unless the economy does a complete turnaround. And we still are talking about COVID spikes, right? So before we get into looking at different yields and different REITs and different dividend stocks, you need to have a good grasp of what's going on in the overall economy. You need to have a good grasp of risk reward. You need to have a good grasp of different assets and how they react in different economic seasons, right? So again, it's not just seeing this great performing stock that's got 13% dividends, right? You need to see what's under the hood as well. It's like, I'm a guy. I think women are beautiful. I like women. If I just meet some random woman outside on the street, like the Matrix test with the red dress. Matrix is like one of my favorite movies. So for all of y'all who've never seen the Matrix before, there's a test to see how well people pay attention. Man sees a woman in a red dress. He gets distracted and he's ready to go in, and she's able to then kill him because he wasn't, one, paying attention, and two, his faculties were all jumbled up, right? So again, when it comes to investing, if I'm a man, I'm looking at a woman and I just say, hey, baby, let's get married today. How does that look? Usually it's going to end off bad. It's usually going to end off bad. Shares 215, just look up STWD. STWD, just Google that. STWD. And so again, you can't always go by first glance. You can't always go by first appearance. That's the moral of that story, if anybody didn't get it, right? You can't go off all of that. You got to do your research. You got to do your due diligence. And then you'll have a lot of people out here talking about dividend stocks are great. We need to find dividend stocks. We need to find REIT stocks because the bank's not paying. Well, the bank may not be paying as much, but the bank is safe, right? So we got to understand, again, the relationship of different investments, different stock types, so we can make proper decisions. Listen, I'm not here to sell anything. I'm here to see our community do better. You know, I'm here to see us get stronger. My ego is tied to our success. By the way, the more successful we are, guess what? Kamari can then do more deals, potentially, right? So it doesn't pay for us to be kind of in a destitute state where we're trying to find jobs, right? Because we know Black folks only spend about 2% of their money in their overall community. And if you make bad allocations in your investments, that just takes it down for everybody, right? That reduces the pot, that reduces the money, the bag, as everybody likes to put it. So again, we have to be a bit more diligent on when it comes to doing our investments. And we got to be a bit more diligent about vetting, right? Vetting information that comes our way from social media, right? Just because y'all see me and I'm here often, that don't mean y'all supposed to take my word as gospel. Y'all supposed to research me from top to bottom to the top. Everything that I'm saying, look up Dividend Yield Trap on your own. Y'all got these great tools, right? Y'all got iPads and iPhones. Use them. Google is your friend. It's your friend. Use it, right? Don't be in a position where you just take my advice as gospel or some other random people that are on social as gospel. You have to do your own research. Why? Because at the end of the day, it's your money. At the end of the day, it's your money. It ain't my money, right? I don't get to buy my steak, my surf and turf, my steak and scallops with your money. I got to use my own money for that. You get to use your own money for what you want to use your money for. But listen, if you're giving it away and you're putting it into risky things that you don't understand is risky, then that's a problem, right? You don't want that to happen. You don't want that to happen as well. You work hard for your money. And since you work hard for your money, you don't want it to just easily slip out of your fingers because you took somebody's advice that 9 times out of 10 don't even know what they're doing. Just to be totally honest with you. So, but But let's look at some more dividend stocks. Anybody have any questions? I know Jimmy had said something. I didn't get a chance to read it. Let me get back to it. So Jimmy says, in my experience, people who buy ETFs end up trading them instead of holding them long term. They're less likely to do that with the equivalent index fund. That is one of the features of ETF. I haven't seen that as much. Most people kind of hold, in my experience, ETFs passively. But when I was working in institutional management, I actually actively traded ETFs. So I get it. You can definitely do it. And it can be more efficient sometimes than actually trading individual stocks. But that's more from a trading aspect. But that's also one of the reasons why I love ETFs more than mutual funds, because of liquidity, because I'm able to get in and out of them, right? From a long-term perspective, right? I don't like the idea of being in a mutual fund and I can't get true pricing until the end of the day. I don't like the idea of being in a mutual fund where my tax situation is tied with everybody else's tax situation. Even if I invested in on July 24th, and maybe you, Jimmy, you invested on January 1. I don't like that. I don't like that at all. I don't like the lack of transparency also that a lot of mutual funds have. Ms. Carroll, you're glad you're here? All right. Well, I'm glad you're here too. I appreciate you being here, and I'm honored that you're here. Thank you so much. So, all right. Nobody has any questions? So Jack, the first three said, you answered your own question from earlier. No one wants to do their own due diligence. Now that's why target marketing is working like it is. You know what, Jack, you're right. You are 1,000% right. But I can't accept that. Well, I don't want to accept it. And you know what? That's something that I just had to deal with potentially, right? Because a lot of people don't want to do their own due diligence. But I'm still going to promote you doing your own due diligence. I'm going to always promote you doing your research. Because at the end of the day, it's your money. And listen, people buy stuff just because I talk about it. I don't like that. I'll be honest with you. I don't like that because it shows me that they didn't do their own research. And you need to do the research. Kelly, there's a lot of people out here giving bad advice in my humble opinion. In my opinion of over 20 years in the business, right? Because what happens is everybody's given this cookie cutter response. There are no cookie cutter responses when it comes to your money. Why? Because everybody's situation is different. Everybody's situation is different, people, right? Kelly, we haven't met yet, right? I don't know. You look pretty young from your picture, right? You look 25 and below. I'm 40 plus. So if you're trying to invest like me, we're probably out of alignment. So, just because we're in different stages of life. So, and that's just going on. And that's just going on, what I see right now. But again, I don't know. What I do know is that cookie cutter, everybody's situation is different, and cookie cutter advice never works. Never works. So I see people talking about everybody needs an LLC. They tell people you get better tax benefits in LLCs, which you don't, right? 9 times out of 10. The same tax benefit you get for being an LLC is the same tax benefit you get if you're just a regular sole proprietor. I see that's like going all around. I see people talking about credit is more important than cash. That's a lie, right? I went to school, I was a finance major. Shout out to Temple University. First axiom or first law of finance is cash is king. But to understand that, we got to start talking about time value of money. And maybe I'll do another live talking about time value of money. That one I think might get a little heady though. And so I'm a little hesitant about that one. But basically, time value of money is $1 today is better than $1 tomorrow. or waiting for your dollar. And what value, for example, what value do you get? So, for example, I don't know if any of y'all ever watched Popeye back in the day. There was a guy by the name of Wimpy on there, and he said, if you buy me a hamburger today, I'll gladly repay you back on Tuesday. That's a time value of money equation. That's a compound interest equation, right? So how much would have been that money that, I think it was either Brutus or Popeye, he would ask all the time, I always forget. But what kind of value would that money have gotten? Let's say Popeye, and let's say it was Wednesday, right? And he brought Wimpy a burger on Wednesday, and he wasn't getting it back till Tuesday. He just lost out on the money. He just lost the opportunity to use that money he had in his pocket for his own investments, for his own benefits. There's a cost associated with that. Now, again, it can get a little heady, some of the calculations and all that, but people need to understand that. People need to understand that. So, again, Kevin says if you're trying to tell people, he does. He does. But listen, we all have to do our own due diligence. We all have to do our own due diligence. So let's see. Sean asks, can you speak on drips? So drips are dividend reinvestment plans. And what drips are is there, again, dividend payments from companies or stock. Let me explain this. So drips are, they give you the ability to buy stocks directly from the company. So for example, I know Home Depot participates in a drip program. So you, instead of going through a broker, you can buy Home Depot stock directly from Home Depot, and you buy it through their transfer agent. But you avoid any brokerage fees and anything like that, and they hold it in your name at the transfer agent. Transfer agent is just the person that makes sure, the company that makes sure the stocks are registered to who they belong to. And when you look at a company like Home Depot, it can be a big job. Now, what I didn't do is, okay, let's see if this is still available. But I'm looking at different stocks, different REITs, trying to find. I want to show y'all some examples of, and it doesn't even have to be stocks. I mean REITs. It doesn't even have to be REITs. It can be any company. But I'm trying to find examples of companies that pay high dividends, but might not be good companies, and explain why to you all, or why I don't think they are good companies. Give me 1 second. For some reason, I am going blank on. For some reason, I'm going blank on. There's a stock screener that I like to use, but I'm going to share this screen with you all. So I'm on Dividend.com. Again, Dividend.com. Hey, Rhonda, how you doing? Common Lotus. I never know you could buy stocks from company. Yes, absolutely you can. I think Walmart participates in drips. I think they do as well. Some of your bigger companies participate in drips. You know what? Here's a story real quick before I go to the screen. A lot of people don't like the idea of buying whole because it's not sexy to them, right? But as y'all know, I do have a tax advisement and preparation business. And oftentimes, sometimes I get to do a state tax, not a state tax, but like inheritance tax, and I guess a state tax returns. And so there was a woman, she had died, didn't have any family, never made a whole lot of money. But what she did was she participated in a drip program. I can't remember the company she was in right now, but through the drip, and she started investing like $50 a month back in the 60s. By the time she died in like 2000-ish, she was a millionaire. She was a millionaire. And so I say that to say you can use a little bit of money to turn into a big mountain of money if you are consistent and diligent to your investing strategy. Now, I never got a chance to check out Bricks. I'll look at it. Remind me, Rhonda, if you come up on Wednesday, we'll look at it. We'll take a deep dive into it. By the way, for everybody who doesn't normally watch me, every Wednesday I do Wealthy Wednesdays. Every Wednesday I do Wealthy Wednesdays, and I answer people's questions. And Rhonda Cox asked me a question that stumped me. I don't get stumped too often, but listen, it happens. And she asked me about this Bricks, BREX. Never heard of it. And I said I would look at it. I would look at it. So, Rhonda, I promise to look at it before next show, next Wednesday. So here I'm looking at some high dividend stocks, right? And these are, things we can just look up. So Frontline, ticker symbol FRO, pays a 36.46 dividend. Current price, $7.68. EURN, EuroNav, ordinary shares. That sounds like some kind of mutual fund, but that's 34.54%. Harvest Capital Credit. Harvest Capital Credit, it's a REIT. It pays 23.94%. Apollo Investments. At one point, I used to own Apollo. That's why I pulled. It sparked my interest. 18.52. Energy Transfer. 18.43. Energy Transfer is a piping company, right? They transport oil. They transport oil, so they get paid. They get paid off of transporting oil from either the refiners to the end user to the from refiners to the end user, like the gas station or to the pump, basically, but also from the drillers to the refiner, also transports through pipelines as well. My IG people, I have 1 minute and 54 seconds left. I am going to end this now, and I'll be right back. So, okay, here's one everybody should avoid, right? So it says it's a REIT. It actually is not a REIT. The Geo Group is a private prison, and they're paying a 17.36 return, 17.36% return. Sadly, it's really not a REIT, and REIT stands for Real Estate Investment Trust. It gets classified as a REIT because typically most prisons have a lot of land. That would be an investment I would totally avoid at all costs. Just my opinion. I'm not into making money or profiting off of people's pain. And most of these private prisons, they're all about pain. That's all they're about. They're all about pain. And it's really sad. It's really sad.
BMH.
We also wanted to so I'm trying to go live on IG, and my IG is not working with me. Start operating. Give me 1 second. And I don't know. I don't know why this light keeps giving me a hard time. So again, I would not be buying the Geo Group. Again, the Geo Group is a private prison. Private prisons are trash. Private prisons suck, in my opinion. Too much going on there. So I'm gonna take notes, right? So I'm just gonna write down a couple of these super duper high yielding dividends, and we're gonna look them up. We're gonna look them up. And so we have FRO, right? We have Harvest Capital, HCAP, and let's pick three, right? Let's pick three. Now, in my opinion, you probably should start to get wary about dividend stocks anytime they get above, I would say, 5 or 6%. There are some good deals, there are some good finds above that, but they are rare. They are rare, and you don't oftentimes find them. So anything over 5 to 6%, I get leery. So, all right. Eagle Point Credit Company, ECC. That has a 13.01% return. It pays that big of a dividend. So 13% a year. So if you remember, we said how much does it pay earlier on, how to calculate that earlier on. Frontline Capital is a 36.46% dividend. And HCAP. What did I do to HCAP? Where'd it go? Harvest Capital. So y'all can follow along with me as I look these up. Now, remember I said dividend yield, right? So these percentages are all, dividend yields. And how do we come up with the dividend yield? That's right, Denise. Our people are definitely in private prisons. So I am not for private prisons any way, shape, form, or fashion. Hey, Mo. Hey, Kendall. Carrie's back. Queen of the Throne's back. How y'all doing? So again, I'm okay with, there's enough opportunities out there. I'm okay with not pursuing things that intentionally do harm to people. So, I don't feel any remorse missing out on what that private prison has. And again, that private prison is listed as a REIT, again, a real estate investment trust. By the way, a real estate investment trust is a tax classification that the IRS gives to usually real estate investment companies that pay out a high dividend or pay out the majority of their dividends to their investors. I want to say it's like 90%. I haven't looked at it yet. All right, Jack, the first three, do me a favor. If you could inbox me that, I'll do that. I'll definitely do that. I might even do a special live just for that. Thank you for that. So Jack says you have to do a video on how to read Yahoo Finance. I was trying to show a friend how to read it, but it's tough to explain when you're more versed than others and not as versed as you should be. I got you. But listen, people also have to take the initiative and start to figure out how to do stuff on their own as well. What's up, Remy? How you doing? Right, that's what it's about. You should be learning every day. I mean, listen, here's the thing, folks. We always talk about wealth. We always talk about creating wealth, right? Number one, you're not going to create wealth if all you do is buy a bunch of name brands and a bunch of foreigns, all right? If your whole mission in life is to spend money, you're never going to create wealth. I'm sorry to break that to you. However, as you start developing the wealth mindset, the investor mindset, that's when you really have a fighting chance. And listen, that opportunity is available to all of us. River 7705, how are you? Thank you for joining us. So we are looking at, let's pull this up. Oops, wrong screen. Give me 1 second as I shift. Y'all got me working on a Friday night, late night. P. Will, 31752. How are you? Thank you for joining us. Tonight's subject is not getting trapped by dividend stocks. Shelby, how are you? All right, so Frontline, $7.68, right? Pays a 36.48 dividend. Its market cap is $1.5 billion. So I hope y'all are taking notes and following along, right? What do they do? What do they do? So Frontline Ltd, right? It's probably an overseas company. Anything usually with Ltd. It's somewhere, an island somewhere. It's in Bermuda. It's an oil and gas company. So Frontline is it's a shipping company. It's a shipping company engaged in seaborne transportation of crude oil and crude products worldwide. It owns and operates oil and product tankers. As of December 31st, 2019, the company operated a fleet of 71 vessels. It's also involved in the charter, purchase, and sale of vessels. So they also rent out those oil tankers as well. And let's see what the financials are. Let's see. So they do a little less than $1 billion a year. And they had profits of roughly $139 million. Not bad. Not shabby. Not shabby. How much cash they got? They got roughly 178 million on hand. So they're it's somewhat profitable. The guy's an investor. How you doing? King's Corner, BMH, how are you? Great video today with the Breakfast Club, by the way, King's Corner. But that's Blackman's Hill, but y'all together. Bowleggers to you, how you doing? So listen, so Frontline is basically an oil tanking company. Nails by Trees, how you doing? Trees, you back to work yet? You open back up yet? So again, they pay a 36.46 dividend. Now, what I would want to see is how long they've been paying that dividend and does it look sustainable? But again, they look like they're profitable. And I would want to see the level of debt that they have. Also profitable in the last quarter. Let's see how much cash they had in the last quarter. Now, it's funny, right? Remember, Yahoo was acting all goofy on me a minute ago. So they got 3.6 billion. Let me go to the quarter. All right, they got about almost 4 billion in assets overall. And now they have $222 billion. And this is at the last quarter, a closing of on March 31st. So remember, corporations, publicly traded companies, they basically give out their earnings report or their report card 4 times a year. So every quarter. So March, then you got, June, and then you have October, and then you have January. So this might be interesting. So they have debt of total debt of 2.39 billion. They have little under 4 billion in total assets. I might have to write that down. So that's not bad. But before I would commit to that, I would want to see who their contracts with. I would want to know why their stock price is so low. Those are all the kinds of things I would want to know about this dividend stock before I committed my money to it. Those are the things I would want to know. All right. So let's put a maybe by FRO. And again, none of these things that I'm talking about are investments. None of them are investment recommendations. All right. This is not investment advice. Everything that I'm talking about is for investment and entertainment purposes only. All right. Remember, anytime you make an investment or considering an investment, you should talk to your investment and or a tax advisor. Past performance does not indicate future results. Basically, just because a stock did good in the past does not mean it will continue to do well. For all my Tesla lovers, Tesla's up high. Does not mean Tesla will continue that way forever. So if you got in and you got good, you might want to think about when or what your exit strategy is going to be. Nothing lasts forever. Nothing lasts forever. All right, so ATAP, right? Harvest Capital Credit Corporation. That's what we're looking at. $4.05. Now, Harvest Capital, for me personally, and my overall investment strategy is a penny stock. I don't do penny stocks. I think penny stocks are the spawns of the devil. If you want to know why, listen, just do me a favor. Google 50 cent. Google 50 cent penny stock. Google 50 cent and penny stock. I don't really bang with penny stocks because they are very easily manipulated and highly susceptible to pump and dump. I'm not really into gambling. And most people that are buying, most people, not all, but most people that are buying penny stocks are definitely gambling. There's a reason why this company is only $4, but let's look at it. Let's get into it. All right, Harvest Capital Credit Corporations. Harvest Capital Credit Corporation is a business development company providing structured credit. So anytime you see it's a business development company, usually they do some type of financing. Creations by Nice, how are you? Kendra Buys Homes, how are you? So they provide some kind of structured credit to small businesses and specializing in leverage buyouts, add-on acquisitions and recapitalizations. So they probably do a lot of bridge loans and some senior secured debt, subordinated debt. The firm typically invests in companies with target equity size of $250K to $1 million. So they're going after small businesses and they're giving them an injection of capital. How much money do they make? What are they working with? Let's see what they're working with. So, do you know anything about the Angora Gold Corp? No, give me a ticker symbol. We'll look them up. Are they a dividend company? They sound like a gold miner. So, last quarter, this company may have had negative revenue. That's interesting. They had negative revenue. Net income, negative $3.6 million. You don't know? Okay, I'll try to search it out. Why did you ask about Angora Gold Corp? So no money. They didn't make any money. They didn't make any money, but they're paying a 23.94% dividend. Now, remember, we talked about dividends and dividend traps. So people might look at this and say, oh, this is sexy. It pays a 23.94% dividend yield. And I can't see the assets. Let's see. All right. Nope, still can't see the assets. But they have more assets than they have liabilities, which are debts. But that still doesn't tell me enough. So again, I would want to know, is this company ever going to be profitable? So for me, I wouldn't touch this. I wouldn't use y'all monies with this. I wouldn't use Miss Denise's money, Miss Carol's money, Miss Rhonda's money to buy this because they're not even making money right now. They don't even have revenue. So, I wouldn't touch this. Again, it looks sexy because it's a 23.94% dividend. All right. So last one, ECC. And then I'm going to, I'll take a couple questions and I'm going to relax for a minute. So Eagle, no, that's not it. Eagle Point Credit Company. Eagle Point Credit Company pays a 13.04% dividend yield. They have, the stock price is $7.36. It is a $219 million company. So it's like a super duper like micro cap company. Year to date, so at the beginning of the year, the stock was $14.60. Now it's trading at $7.36. So we see this fell. So, again, this is part of doing y'all due diligence, y'all. You want to know if you're buying a company, right? We're talking about investing. We're not talking about trading. We're not talking about speculating. We're talking about investing. And so when you invest, when you're in the stock market, you are buying a piece of a business. The stock represents a piece of the business. So you want to know about the health, the life, the viability, the sustainability of the company. And it doesn't take that long, right? I'm doing all this on finance.yahoo.com. Somebody put finance.yahoo.com in the comments for me, please. So Eagle Point Credit Company is a closed-end fund launched and managed by Eagle Point Credit Management. It invests in fixed income markets of the United States. So basically, they buy bonds. Anytime you hear fixed income, it's talking about bonds. All right. So the fund invests in equity, junior debt tranche. Again, debt is a bond as well. Debt tranches of collateralized loan obligations. You might see those talked about as CLOs also, consisting primarily of below investment grade U.S. senior secured loans. So they buy a lot of loans, they invest in a lot of loans, and they invest in a lot of bonds. Let's see, are they making money? Basically, what they are is a hedge fund. But again, negative money, negative revenue, negative income. So even though this company pays 13.4%, how can a company that has negative income continue to make that payment? I won't give you the details. I won't give you the details. So they have roughly 400 million in assets, right? And an asset can be cash, an asset can be an investment, an asset can be a building, right? An asset can be also what's called goodwill, right? And I'm not even going to go on to what goodwill is. That will leave y'all mind boggling. It's kind of made up value. It has value, but not a whole lot of value. As we relate to it, it's not tangible. So I wouldn't buy ECC. The only one I might look at is FRO. Why? Because all of the prospects, all of their financial prospects, they look shady. They look super shady. And so, again, I'm not really looking to just give my money away just for the sake of giving my money away. Now, P-Well 31752 asks, have I heard of Angora Gold? So let's see. ANGKOR. So there's Angora Resources Corp. Let me see if they're the same thing. You gotta make sure you're looking for sometimes companies will have Different variations of names. Okay, so Angor Resources, it is a Canadian company. Ticker symbol is ANKOF. So it looks like it's a pink sheet. It's 6 cents. I definitely wouldn't buy that. Who gave you that stock pick, P. Wills? Who gave you that? So I got it up on the screen. It's 0.0637%. I wouldn't touch that. And it's not a dividend stock. You talking about dividends tonight, y'all? What's going on? But I'll look it up anyway. So Angor Resources operates as a miner and oil and gas exploration company, right? The company explores for gold, silver, and copper deposits on its 5 mineral exploitation licenses. Give me 1 second. Let's look at the money. No revenue. No revenue. I wouldn't touch it. I wouldn't touch it with your money. And again, I don't advise for beginners. I do not advise penny stock investing. I do not advise any of that. Again, it's not an investment recommendation. So now I'm looking at the trend. This thing has been trading since 2013. It was 38 cents when it debuted on the market, and now it's 36 cents. So it was trash back in 2013, and now it's extra trash in 2020. I wouldn't buy it. Now, again, a lot of people like to gamble. Not my thing. Because, if you buy 1,000 shares of a 6-cent stock and it moves 6 cents to 12, you made a good amount of money. But again, like I said, there's so many other factors when we're looking at investment in penny stocks. Again, in many penny stocks experience pump and dump. So I wouldn't touch it. So, friend. Oh, hey, Cindy. I didn't know you were here. Deal Finding Diva, how are you? We got to get together, Deal Finding Diva. Leo Lady, how are you? Well, folks, it's Friday night. I'm talking to y'all at 9:30 on a Friday night, and we've been rocking for about an hour. So I'm going to jump off. But listen, if y'all have any other questions about dividend stocks, the value trap when it comes to dividend stocks, just give me a holler. I'll be more than happy to talk to you about it. Hit me in the inbox or the DM or send me a text. You can always reach me at 484-278-1357. Again, I'll put it up on the screen for y'all. So again, you can always reach me at 484-278-1357. Ty, formerly known as Nas. All right. And listen, do me a favor. If you haven't done so yet, go on over to my YouTube page. Like, subscribe to my YouTube page. I'm trying to grow my YouTube following. I'm trying to see, how many more people I can help. So go on over to my YouTube channel. It is youtube.com/Kamari Ellis. Again, /Kamari Ellis. I thank you all for being here with me tonight on a Friday night. Like, listen, any night I can talk about money. Any night I can talk about investments, taxes, business. It doesn't matter. So I'm here. So if y'all want to talk about it, we can talk about it. But I will see you really soon, and have a great day or great night. Bye-bye.